million Americans cannot find the jobs that they need to pay their bills and to feed their families.
Did you know that inflation in the U.S. got so bad in the early 1980s that the Federal Reserve had to raise interest rates to a crippling 19%?
The long-awaited economic recovery.
Honestly, I can't imagine how bad that was, because right now we're hovering right around 5.5%, and things seem bleak for the economy.
Well, I mean, you gotta cut back on the grocery bill quite a bit and cut down on the heat.
Getting married in July, I don't even know if I got a job.
I feel rotten, but what can you do?
But recently, financial analysts and institutions like Bankrate, Citigroup, and Goldman Sachs have predicted that the current economic conditions are indicating interest rates are likely to get cut in the next month or so. So this made me start to think, hey AI, when interest rates drop, exactly how does it help consumers?
When interest rates decrease, the cost of borrowing money becomes cheaper. This means that consumers can take out loans for big-ticket items like homes, cars, or even education at a lower cost. For example, if someone is considering buying a house, a lower interest rate on a mortgage can reduce their monthly payments, making homeownership more affordable.
None of this was too surprising to me, but it seemed a bit odd that letting people borrow more money at a cheaper rate is one of the best ways to stimulate the economy. So I asked AI why that is.
That's a great question. While it might seem like lower interest rates just encourage more debt, they actually play a vital role in boosting the economy. For example, when people buy homes or cars, it doesn't just benefit the buyer. It also supports industries like construction, manufacturing, and retail. More spending means businesses may need to hire more employees to meet demand, which can reduce unemployment and increase overall economic activity. So, while it does involve more borrowing, the idea is that this borrowing leads to more spending, which in turn helps the economy grow.
Now, I understand what AI is saying here, but it seems like this is just a weird, never-ending cycle where lower interest rates lead to more spending, which leads to more debt, which leads to more spending, and this endless cycle continues. But when you consider that the government collects taxes every step of the way from every person and every business involved, I can see how that activity is a net gain for the country. Anyway, this was a pretty simple response, but I wanted to see how else lowering rates helps consumers, and this is what AI responded with.
Another way that lower interest rates help consumers is by boosting consumer confidence. For instance, if someone sees that they can get a low-interest loan for a new car, they might feel more inclined to make that purchase. This confidence can extend beyond just cars. It can influence decisions about purchasing a home, home renovations, vacations, or starting a new business. When consumers feel good about their financial prospects, they are more likely to spend, which further stimulates economic growth.
I get it. Consumer confidence means spending. But does that mean that AI thinks more people will be buying houses once rates go down? I asked, and this answer was kind of a surprise.
Well, lower interest rates generally make mortgages more accessible, which can encourage potential buyers who were previously deterred by high rates to enter the market. However, this increased demand can lead to higher home prices due to heightened competition among buyers. Plus, keep in mind that even though rates may lower slightly, many homeowners currently have rates locked in at around 4%, so until rates fall further, there may not be as many home sales as some experts think.
If I'm being honest, I didn't think deeply enough about this question when I asked it, and this was a really interesting perspective. But I wondered how else lower interest rates could help consumers, and this next response really blew my mind.
Lower interest rates can lead to increased disposable income for consumers. When rates drop, individuals with existing variable rate debts, such as credit cards or adjustable rate mortgages, may see their interest payments decrease. This reduction in interest expenses means consumers have more money left over each month to spend or save as they choose.
Considering credit card debt in the US is around $1.14 trillion, and roughly 103 million Americans wrestle with credit card debt every month, that reduction in interest expenses will give a lot of people some extra money to spend. Now, this made me wonder one thing related to credit cards. So I asked how many of these cards have a variable rate.
Most credit cards have a variable annual percentage rate, APR, which means their interest rates can change from one month to the next. Fixed-rate credit cards are less common and are typically offered by smaller financial institutions.
Frankly, I'm one of those people who uses credit cards strictly for the points and pays them off month to month, so I didn't even realize interest rates could change so quickly and often. But I wanted to move on to the next reason why dropping interest rates can help consumers, and AI definitely didn't let me down.
Lower interest rates can also benefit consumers indirectly by stimulating business investment. When rates are low, companies find it cheaper to borrow money for expansion, research and development, or upgrading equipment, which can lead to job creation and potentially higher wages.
I thought this was a very valid and thought out point that I had never even considered. More money means more money for everyone, which includes businesses, and ultimately, this rolls downhill to consumers. I figured AI would be done after this one, but I asked if there were any other reasons, and as usual, AI got my hamster on its wheel again in my head and got me thinking.
Since it can stimulate investment, lower interest rates also lead to higher asset prices, such as stocks and real estate. When borrowing costs are low, investors are often more willing to invest in the stock market, which in turn drive up stock prices. Similarly, lower mortgage rates make it cheaper to finance real estate purchases or refinance properties, which can increase property values. For consumers, this can mean an increase in the value of their investment portfolios and home equity, potentially improving their financial situation and net worth.
Now this was the next level of thinking I was hoping for. Simply put, lower interest rates mean people have more money, and when they do, they tend to invest in stock or property. So indirectly, lower interest rates lead to stronger stock and real estate markets. From here, AI had one more thing that it wanted to tell me.
While it might seem counterintuitive, lower interest rates can also encourage consumers to seek out alternative savings and investment options. When traditional savings accounts offer lower interest rates, consumers may look for other avenues to grow their money, such as stocks, bonds, or mutual funds. This shift can lead to better financial literacy and a more diversified investment portfolio.
At the moment, everyone is rushing to invest in high-yield savings accounts, but when those rates fall and the return isn't looking as strong, people want another place to park their money. No surprise there, but a very, very valid point. I learned more in this conversation with AI about interest rates than I have in the last 15 years of my life. In the news, we consistently see, high interest rates are bad, but nobody dives into the details to explain why, except for our AI, of course. If you like this video, don't forget to click the like button and subscribe to the channel so you don't miss out on my future finance-related conversations with AI. And one last thing to remember, this is not financial advice, and investing in the stock market involves risks, so it's crucial to do your own research and consider your financial goals before making decisions. Hope you enjoyed, and I'll see you in the next one.